As we all know, stock markets have been under significant pressure over the past year, with several factors putting them under pressure. The main ones include high inflation, rising interest rates, and the Russian-Ukrainian conflict. These factors have affected people's appetite for investment, which has been particularly felt in the financial segment. In this video, we look at selected stocks of 4 banks and assess their current situation, trying to uncover important price levels that will play a significant role in their eventual growth through technical analysis. The financial segment was one of the losing market segments last year, ending up losing 13.1%. In particular, investor disinterest in the long-term investments that form the basis of banking products and the outflow of capital into cash caused year-over-year declines in sales for the largest U.S. banking houses. Banks are currently teetering on the edge of 2 opposing fundamentals. The positive one should be good for banks, as higher interest rates make bank products more attractive, due to the near-zero risk, at an attractive yield. On the other side, however, is the specter of a slowing economy, which inevitably forces the population to reduce its spending. The slowing economy will also affect banks in terms of the loans they offer, as demand for these products from businesses and citizens will be reduced. Let us now look at the specific price charts and let us think about the situation in the financial sector from an investor's point of view. Number 1, Bank of America. Bank of America shares have been trading in an uptrend zone since 2020, respecting the values of the rising trend line. This technical indicator has worked very well as support twice already, and each time there has been a rebound and an increase in the value of the stock. The shares of this bank have also already managed to test the nearest resistance, opening the way higher. While the stock offers an optimistic outlook, it is not so glorious in terms of numbers. Bank of America posted year-over-year earnings growth of just 0.34%, with annual revenues of nearly $95 billion. Forecasts for this year, 2023, however, are more optimistic, with growth expected to exceed $100 billion to $103 billion. The bank pays a quarterly dividend of 22 cents. Number 2, Citigroup. Citigroup shares have been trading in a sideways trend since 2013, but one that offers significant volatile price movements. Thus, trading has been taking place within a price range of $36 to $80 per share, which dividend investors in particular like to see. The stock is now trading below its long-term POC, and a test of the lower edge of the sideways trend is expected with a subsequent stock upside. Citigroup Bank reported modest growth in its revenues, up by a predicted $22 billion. Similar moderate growth is forecast for 2023. Citigroup offers shareholders a dividend yield of 4.16%, which amounts to a quarterly dividend payout of 51 cents per share. Number 3, Wells Fargo. A successful 2021 is already in the past for this bank, and this year is unlikely to go the way management envisions. The year-over-year decline in revenue is 6.24%, which translates to a $6 billion drop in revenue. The bank did break a 3-year trend of dividend cuts last year, but with declining sales, that trend may return. Wells Fargo's current dividend is 30 cents per share. Wells Fargo shares have fared slightly better, trading above the downtrend line and showing modest growth, but with high market volatility. The stock's most recent bounce upward occurred at the $37 price level, a level that if breached would open the way for the stock to fall. Number 4, JPMorgan Chase. This has been a highly volatile instrument over the past 2 years, and after a growth year in 2021, it experienced a full-year decline in 2022. However, the end of this cycle was positive, and JPMorgan Chase stock rose again thanks to a buying reaction to the strong volume level and rising trend line. Now, the last resistance at $150 stands in their way to new highs. While the stock is on a teeter-totter, the bank's revenues are in a consistent level for the second year, around $130 billion. The bank pays dividends of $1 per share to shareholders on a quarterly basis. This year will be a challenging one for the financial segment and for large banking institutions. Fundamentally, they are trapped between declining economic activity, which reduces demand for banking products, and rising interest rates, which in turn make banking products more attractive to the public. This clash of fundamentals may change during the year, which could also signal the establishment of long-term equity trends in this market segment.